Breaking news, the world is on fire, and somewhere on Wall Street, a hedge fund manager just ordered his third yacht. While the rest of us are doom-scrolling through conflict updates, the stock market is doing something deeply uncomfortable. It is making people rich. Not all people. The right people. The ones who move before the headlines even loaded. Here's the uncomfortable truth about war and markets. By the time the average person hears the words conflict has escalated, the institutional investors, the hedge funds, the guys with Bloomberg terminals and zero empathy, they already bought in, profited, and are now casually sipping something expensive. The market does not wait for your morning news alert. It prices in fear, tension, and geopolitical instability weeks, sometimes months, before the first headline drops. So if you are reacting to the news, congratulations, you are the exit liquidity. Dark, absolutely. Accurate? Unfortunately, yes. Defense contractors, these companies are essentially the arms dealers of the stock market, and during conflict cycles, they print. Raytheon Technologies climbed roughly 110% over approximately 2 to 3 years during elevated global tensions. Northrop Grumman was up around 60%. General Dynamics gained approximately 57%. Lockheed Martin added around 37%. Governments do not cut defense budgets during war, they expand them massively. And sometimes literally in the form of gold and treasury bonds. It creates bag holders too. Airlines get absolutely wrecked, fuel costs surge, travel demand collapses, and suddenly that airline stock you bought for the post-pandemic travel boom is looking very sad. The broader market takes hits too. The S&P 500 has historically dropped anywhere from 4 to 9% during the early stages of major conflicts. Tech stocks get rattled by uncertainty because growth-focused companies hate instability more than anything. When nobody knows what tomorrow looks like, investors stop betting on 10-year growth stories. Here is where it gets genuinely interesting and slightly ironic. Some of the obvious winners, the defense stocks, the oil plays, they actually dropped early in certain conflicts. Why? Panic selling, profit taking. Investors who already made gains decided to cash out the moment things got real. The market is not logical. It is emotional, reactive, and occasionally completely irrational. Expecting a straight line up just because a company makes weapons during a war is the kind of thinking that turns confident investors into very quiet investors. The recovery trade is often just as powerful as the war trade, and it catches just as many people off guard. What happens after? When conflict de-escalates or peace negotiations gain traction, markets tend to surge. Tech stocks rebound hard, consumer and travel stocks recover. The broader market rallies because uncertainty, which is the actual enemy of stock prices, starts to fade. Recently, markets jumped significantly on early signals that tensions involving Iran could be moving toward resolution. That is not a coincidence. Uncertainty going down equals risk appetite going up. Whether you play it or not is entirely up to you. War does not make stocks go up. Timing does. Money is made before the headlines, not after. The investors who win are the ones who understand cycles, read geopolitical signals early, and move with discipline rather than emotion. If you are buying defense stocks after the conflict is already on every news channel, you are probably buying someone else's exit. The game is not about being right. It is about being early. And just to be completely clear, none of this is financial advice.